Thursday, July 28th, 2016. Monaco 64 here, home of alternative economics and contrarian views. I'm going to be covering gold and silver today and the Federal Reserve, which had its meeting ended yesterday, the FOMC meeting. So, gold and silver had good days yesterday. We closed, and I take the 10 p.m. London time close. Gold closed at 1339. It was up 1.5% on the previous day close, or up $20. So we had a low of 1315, around 1315.88, and a high of 1342. Silver closed 3.6% up. It closed around 2034 versus 1963 the previous day. So and it had a high of 2041 this morning. Gold right now is around 1340. The high's been 1343. Silver is at 2028. It's down a little bit. The high's been 2052. And also the HUY index, which is the gold bugs index of mining shares, was up 4.69%, and the XAU index was up 4.45%. So getting to the technical picture, here's a short-term chart of gold. And as you can see, since the low at the end of May, beginning of June, we've been seeing higher highs and higher lows, and it looks like we've held now this trend line coming up from beginning of June, just in the in the teens, like 13, 14 area. And yesterday, very good day there, as you can see by the move higher. And that trend line coming above, where we're just trading above, is from the high in September 2011 of 1921 and the high in September 2012 of 1791. So in the longer term, that line seems to be quite important. It's just around 1340 right now, but it goes down, as you can see. The recent highs early July have been 1375. So these are targets in the short to medium term, I would say. Going into the longer term picture of gold, we got that trend line again. You can see it looks like it's acting as a bit of resistance. But I would say that the 1392 high of March 2014 is the next big target. And if we can break that level of which we're very close, it would confirm even further the low in gold that we saw on December 2015. It would confirm that as a medium to longer term low, I would say. Going into looking at silver, short term, as you can see, we've got the similar picture as in gold. Since the beginning of June, we've seen higher highs, higher lows, and we've held just around the 1930 level. Trend line there seems to be unbroken, and 2069 was the July 11th high. That seems to be the next target. And then there was that spike on the 4th of July above 21. We'd need to break that as well. Longer term picture in silver, we're forming a continuation pattern, it seems to me, a bull flag. That's a weekly chart. So that flag could consolidate a bit further, you never know. But we'd need to break above 21 to be positive that the bull flag formation is for real. And the target of that bull flag would be around $23, which would take us above the March, I think it's, is it March, the high of 2114, sorry, the high of 2014 at 2218. So that would be a good confirmation that we've also seen the lows in silver, just like in gold. So it looks like that bull flag could do that for us. So that's the picture for gold and silver. They're looking quite positive right now. And yesterday as well, we had the FOMC meeting. They ended their two-day meeting and they released their statement and their press release. It's only 2 pages. I'll read a little bit, you know, what they said. Because sometimes, you know, you read articles and people say, oh, the Fed was hawkish, but, you know, they aren't really hawkish. So I read from that press release, and I quote, in determining the timing and size of future adjustments of the target range for the Fed funds rate, the committee will assess realized and expected economic conditions relative to its objective maximum employment and 2% inflation. This assessment will take into account a wide range of information, including measures of labor market conditions, indications of inflation pressures and inflation expectations, and readings on financial and international development. And it says, in light of the current shortfall of inflation from 2%, the committee will carefully monitor actual and expected progress towards its inflation goal. And it just goes on to say that, you know, they're also going to keep rolling over the bonds that they have in their balance sheet from the QE programs they've had in the past, and that they're going to keep reinvesting the principals when they're paid off, and that they're going to be doing that well into the next Fed funds rate rising cycle. So they've got no intention of shrinking their balance sheet. And you know, the other thing that I would note is that Citibank comes out with an index that measures how economic data are performing. So they've got the expectations for the economic data that come out of the US, and if they come out as expected, that's the index stays at 0. They come out higher than expected, the index goes above 0, and vice versa. And this city surprise index, as they call, is at the highest level since the end of 2014, which means that the economic data are improving and coming out a lot better than expected. I'm not saying the economy is doing well, but, you know, if the Fed's looking at the data, how come, you know, they're still near 0? And the other thing I'd like to point out is an interesting point about the unemployment rate. And I bring this article from December 12th, 2012, so almost 4 years ago. It's from Biz Journals, B-I-Z or B-I-Z, journals.com. And the headline reads, Fed Chairman Ben Bernanke's 7 message for business. And it goes on to say, the article, the Fed will keep the Fed funds rate near 0 until the unemployment rate falls below 6.5%. So, and it goes on to say, financial markets, for example, will be able to use their own models to predict when the unemployment rate will go below 6.5% and prepare for changes in the Fed funds rate, Bernanke said. So, it's a load of rubbish because the unemployment rate is around 4.8 to around 5% right now. And, you know, the Fed raised rates in December last year by a puny 25 basis points or 0.25%. We're still, you know, below, almost at 0%. And, you know, this article is just rubbish. You know, it just proves that the Fed has no clue what they're doing, and that the reason they're keeping rates low is not because of economic conditions, but is just to keep the government solvent because it has so much debt, and also to keep the banks solvent because they're, you know, their derivatives mountain, you know, huge derivatives mountain, which keeps all asset classes manipulated for the Fed. They're highly dependent on interest rates. When people write up over-the-counter derivatives, a lot of times it's based on interest rates. So if interest rates start rising, all these derivatives, will go underwater. And this article goes on to say conditionally, oh, the 6.5% threshold isn't an automatic trigger. That's how they get away with these things. It's like the FOMC statement or press release. They say, the economy is doing better, things are improving, but we will continue to monitor and we will have to change policy if this and this happens. They've got no clue. So, I don't know if it's if it's a coincidence or if gold and silver went up yesterday and had a good day because of, people are realizing the Fed's got no clue. Either way, the technical picture is looking better in gold and silver. And in my opinion, the Fed's continuing to lose credibility. While they've had almost zero credibility for me, for many years. But, I'm not the market. So it looks like the balance of market participants and investors still seem to trust the Federal Reserve and other central banks. So talking about central banks, tomorrow the Bank of Japan is expected to announce maybe further drops to more negative interest rates and more QE. That's what people are expecting. So that would be something to look at for tomorrow, the BOJ. So if you enjoyed my video, my analysis, please like, share, and subscribe to my channel. Take care. Bye.